How's your
I know,
Friday
right?
been?
Well, I had a meeting with this total tool, right before this.
The tool of all tools.
Like the creator of tools. That's
That's
that's that's what it
there you
is.
go.
The two by
Way
the
to
two by two tool.
like what are the X and Y axis?
Oh, this is a family-friendly office hours here. I don't know if
Oh,
I can get. It's well, on one axis is how much pony shit you find laying around.
because there's got to be a pony around.
That's right. That's right. The more pony shit, the more likely there is to be a pony. Um, well, that is long enough vamping. Welcome everybody to our regular Friday office hours. We are live every Friday, noon Pacific, right here on YouTube and LinkedIn to answer whatever questions you guys have about startups. We have a ton that were submitted this week. Not sure we're going to get through them all, but we're going to do our best. We do prioritize the live questions because we love you guys coming and hanging out with us. So if you got a question, throw it into the chat. It's down here if you're on LinkedIn, and I think over here if you're on YouTube, but I'm honestly not entirely sure because I'm not watching this at the moment. So there you go. But throw the questions in there. We are more than happy to answer them. And if you want to submit a question in advance to get a little bit more breathing room, we have a form you can fill out. It is anonymous. We don't collect the email address. We don't ask for a company name. We only have the detail that you give us. But so if you do want to ask like a more robust question, go to jdm.bio, hit the calendar. Right there, you can submit a question as some people have done. I'm pointing to a screen you can't see where I have said questions open. But with that, Cameron, how are you?
Doing well. Ready to dive into some founder questions, and just made me think of a question we got yesterday of so what do you do? This is basically what we do all day, is just answer founder questions and see patterns amongst them. So looking forward to just continuing another day.
Yeah, this is it. This is what we do. I am going to, before like we dive into the first question, and I'll come back to this at the end. But I'm going to do we're going to get a little shameless plug here. So this QR code here is to apply to the Traction Lab Investment Readiness Engine. Brand new.
Ooh,
We
the
just announced
ire.
this like 10 minutes ago. Not really, but it was like an hour ago that we announced this as a new program that we're super excited about. So maybe we'll just take 30 seconds to say it, and then we'll come back to it at the end because we'd love to get your participation in it if it's right for you. But we have a new program that is generously funded by the City of Sacramento's Innovation Grant Program, where we are going to work with 15 companies over the course of about 9 months to ramp up their fundability. We're going to work on the growth side. We're going to work on the actual fundraising side, and we're going to have some experiment cash, some non-dilutive experiment cash that we're going to chuck at these companies, and we are also going to be putting together an equity investment to the company that does the best throughout those 9 months. So we're putting together what we call a special purpose vehicle, which is an equity investment, a little syndication that we're going to put together. That's going to be about $100,000. So we're going to chuck 6 figures at a company. So if that sounds like something that you're interested in, we are accepting applications now. And if you apply, regardless of whether you get accepted or not, we are going to provide you with our investment readiness assessment. So we're actually going to provide you some pretty deep feedback on your underfundability. So I just wanted to kind of toss that out there. I'll leave that up for a minute, and then I will close it out. Anything that you want to add to that, Cameron?
No, just looking forward to working with about 15 founders and systematically acquiring their customers and proving out their investment readiness in the process. So, awesome opportunity to dive deep into getting that engine for investment ready to rock and roll.
Well, awesome. Time to rock and roll. Time to lock and load. Let's do this. Got some questions that are pretty cool. But I'm going to start actually with one of the questions that we had from last week. So last week we did a special crossover edition of our office hours with our Traction Lab Venture School, which is one of our programs that focuses on early traction and getting paying customers. And so we invited some of our Traction Lab friends to come backstage with us. They were on screen if they wanted to be. be and actually ask their questions live of a special guest that we brought in, which was Nikki Sims. It was a lot of fun. Check out the replay, either wherever you're watching this now, on YouTube, LinkedIn, the replay's there. And see if you want to see how an experienced some investor in the VC space thinks about those, experienced operator. But we had a couple of questions that we didn't get to from one of our TLDS members, and so I wanted to make sure that we do it right by our community. So we're going to come back to a couple of questions that Jessica had, and then we will dive into some of the questions that were submitted in advance in the forum and any of the questions you guys got in the chat. You cool, Cameron? Rock and roll?
Cool. Let's do it.
All right. Let's see. We covered Jessica's first question. She asked a series of questions in writing, which is why we didn't get to all of them. So she said, what would make a category-defining platform claim credible to an investor who knows nothing about the industry? So a lot of startups, it is for context, a lot of startups will claim that we're creating a new category. It's category defining, we're unique. And so but what would make that claim credible to an investor? What do you think, Cameron?
Well, yeah. So I think the first for me comes to the team, right? So do you have experience in the industry, right? So if we're hopping straight into the 8 T's of fundability, is like, does the team have a connection to the industry? And certainly we know that you do. You have a family business in the space, and so that can kind of prove out some of those opportunities. And so that would be kind of the first area that I would be focusing on. And then, not to sound too much of our tools here, but then what's the path to this being a fairly large market opportunity? And so in terms of it being category defining, you have to have a clear understanding of who that customer is and the size of that problem for them, right? And so it starts with the foundation of the knowledge base that you have there, and this is why we're building in it. We have experienced a pain point ourselves, and we know that this is a problem that others are facing because they've shared it. They shared urgency and severity related to it, and so it kind of always goes back to the data and speaking to it versus it being just another thing. I think the key element, and I'm going to pass it to you, JDM, in terms of the category defining platform. And so part of it is we're coming in saying we're going to disrupt this industry that predominantly has been paper based, is what you're saying. And so the big thing is understanding the severity and urgency related to that problem and having credible evidence to prove that they're willing to switch away from this because there's such a leap in value that they're seeing in taking on this technology. And so if they're historically late to adopt technology, we have even greater switching costs in terms of the mental load and changing processes and other things that we need to have this large demonstration of what the potential value would be. So those are the three things that stand out to me, is both the team understanding of understanding the nuances of the problem, severity and urgency with that customer, and then the demonstration that there's actually value to them going through the switching costs.
That's great. And so I love that you started focusing on the internal aspects there. And the only thing I'll add on that, and then I want to address the market side, is that we're going to trust the team, the creators of that category, who if they have a framework or something that's actually teachable, that's directly this is the thing that makes that defines the category, and that framework of category definition has a feeling of inevitability to it. That just by saying it's oh, well, yeah, duh. Right, when you can explain it in that framework, that sort of starts to make sense. Otherwise, we're not really talking about a category. We're just talking about a spin, and a spin and a category are two different things. But most importantly for me, the things that define a category are actually not by the startup at all. They're entirely from the market. And so I'll go concentric circles and I'll move inward toward the company. So big 30,000 foot way away, we're going to want to see really clear examples of why now. And that's going to be there's a regulatory shift, there's some technology or other infrastructure that's unlocking something that was previously unlocked, right? This is AI is going to allow us to do this where we couldn't do this before. There might be a shift in the cultural zeitgeist, right, that makes that a new category viable where it wasn't before. All of those things that are like arguing for why this makes sense, right? So that's from the market, like that's starting to show those signals of like the negative space where the category can exist starting to get defined. The next thing that we want to see, like from the outside, I would say is that it's not like a lot of people think of like a category a definition as being like, well, nobody's doing this, we're doing this, therefore we're creating this new category. And that's not really true. What it actually is that we're seeing the incumbents in that space start to fail. They're starting to not do well because of all of those like why now things. And we're starting to see that proof that those solutions were tried in this new context and they're breaking down in like a fairly specific and kind of explainable way. The last thing that I'll mention is the behavioral evidence itself. And this is one of the most important ones. So like I liken categories to like the word cool. Like as soon as you call yourself cool, you're no longer cool. And it's like, and as soon as you saw like
Don't you?
it's
Do you do that? Do you,
I do not. I'm definitely not a cool guy. But that's not a word I said. It's like same thing. Like it's off-putting when a hero describes themselves as a hero, right? That like we're
right.
supposed to say, I just did what anybody would do, right? There's that thing that you lose that status as soon as you say it. Hackers are famous for that too. As soon as you call yourself like a hacker, you're no longer really a hacker. So it's the same thing with like the category definition that this needs to be coming from the market. And what like there's a couple ways that looks like you could have what we call referenceability, where people are just literally talking about you. Like that's a thing. Customers are talking about you. Competitors, importantly, are starting to talk about you because now that's pointing to this new thing. But then on top of that, if we're talking about creating this category and doing this thing in a new way, there's new language that comes with that. And that language didn't exist before. And so that's your language. And we want to see customers starting to use that language or competitors starting to use that language. That's positioning you as the leader in this new category that got created. So those are the things that I would say. For me, it's mostly about what's outside the company. If you just call yourself a category creator or you're calling this a category, it's probably not. It's probably just an underserved market, which is great and that's fine, but it's not a category definition. It's just like a rebrand of something else. So yeah, I could probably go on with other things, but that's probably enough, right? Are we good?
No, that was a category defining answer, Josh.
You are too kind. Thank you for your contributions to defining this category with me. We'll have to go, if this were the podcast, this is when we would start riffing on like, what is
This is the
actually about the
podcast.
category? Well, yes, we replay this on the podcast feed, but this is our live office hour. Okay, well, anyway, so there's that. So cool. The next question from Jessica is kind of interesting. She said, "What's the most credible way to articulate defensibility when the industry has no existing digital standard?" That's actually super interesting because, like Cameron, you were mentioning like this paper process, like paper digitization, and Jessica did ask her question last week about that. But like, what's a credible way to articulate defensibility when industry has no existing digital standard? I actually don't think it's any different. So there's because they're either going to go back to paper or they're going to go to a new entrant competitor. And so for me, like it's actually not any different to articulate defensibility here just because the existing solutions are on paper. It was either easier to do on paper and they're going to go back to it because the switching costs were too high or the trade-offs were too severe, or you're going to start this motion, maybe even divide a category. Competitors are going to start cropping up, and you didn't have enough defensibility, didn't have a big enough moat, and so there was no loyalty, and everybody jumped ship to the new thing, and that's not unique just because it was there's some digitization involved. So I'm not sure it's any different. What do you think, Cameron?
Yeah, I think it's if we're tying our defensibility to the paper product, like it's pretty clear. But what we're not maybe thinking about is the future incumbents. So if this is successful in defining the category, who you want to defend is the people that are like, oh, we could build this too, and we could do it better in these ways. And so how are you defending against them? And so is that a trust element? Is it something totally different? Right? There's a whole set of ways that you can start to build that moat. But again, it's less of it being tied to, from my perspective, going back to the existing paper, like that is less of who we want to defend against, more about potential incumbents if we do define the category.
Cool. I said we keep
Oh,
for
were you saying I was cool, or that was a cool answer, or
it was
you're
both,
messing
man.
around
Cool
with all
answer.
this stuff? Like you weren't even paying attention. What did I say? You don't even know what I said.
You dropped a lot of pony poop around, so there must be a pony
Pony
here
poop.
somewhere.
Pony poop.
No, I love it. We need to fix the graphics on here. That's why there's like no branding on here, because we changed the logo and we haven't gone back and done it, and then it's like really in the face because we're not like super far back, and so we just have to come with more minimal one. But I keep forgetting to do that. So that was what I was slightly distracted by there. Okay. All right. Well, this last one here, I'm going to tee up for you, Cameron, and we can recommend a prior
Oh.
episode of the podcast on. But it's how do investors distinguish between a feature, a product, and a defensible platform in a vertical SaaS company? What makes a feature versus a product, Cameron?
Well, as long as it's part of someone else's roadmap, then you're a feature. But no, I think to reiterate the question: how do investors distinguish between a feature, product, and defensible platform in a vertical SaaS? Right, and so part of it is like, are you just a little add-on to what the existing kind of alternatives are, or are you actually like fundamentally different and deriving value on its own? And so basically saying with like we see this often where it's like, oh, we added on this particular feature, and so therefore we're like totally different, but the overall like feature isn't that much different. You just added kind of one little thing, and so really that's like not defensible in terms of like how we would think about it is like, is that fundamental to the value creation and how they're being underserved in the market? And so going from, say, a paper product to a technology, that's clear that that's a product to a degree, right? And so we want to then understand like, what's the robustness of the deriving that particular outcome that we're ultimately trying to achieve. And so is there a set of features that are embedded in the platform, or is it that we basically just digitize something that's taking them from a hand worksheet to a Google Doc? Well, that's probably less of a defensible product. We've kind of are just a feature in that standpoint versus it actually standing on its own. And so we really want to think about, like, when we think about that question, is they're going to be tying the product to the value creation, and what's the stickiness of that value creation. So that's what comes to mind for me. What about you, JDM?
Yeah, I think so. I mean, I don't have a lot else to add, add to that. If I'm being honest, I think the roadmap thing that you opened with is really like the best summary. Like, if they can literally add it to their roadmap, then it's a feature. And nobody invests in features, and that's just not very interesting. So I'm gonna let your answer stand as the definitive answer.
It's the first time it's ever happened on the Traction Lab podcast. So
oh, right. Okay. So I take one of our pre-submitted questions. So thanks, Jessica, for all the great questions. Sorry we didn't get to them last week, but hopefully that is helpful. You only got us instead of Nikki for those last few questions, but hopefully we count for something. All right. Now, this is a deep tech hardware play targeting diesel and sustainable aviation fuel customers. They have an MVP in progress, and their question is on valuation. I am not sure how much to ask for in the pitch deck. I think 250,000 is more than enough to get us started. Some of my team thinks 3 to 5 million. My contract manufacturer suggested 10 million. And we have a recently signed NDA with UPS on biofuels. So I want to start by kind of teasing apart some of the terms here.
Yeah.
Is that where you're going to go with that? Okay.
Yeah, it doesn't seem like they're talking about valuation. They're talking about how much they're gonna raise. That's how I read it. But.
Right. Yeah, exactly. So, like, just to clear out a couple terms. So, the valuation is how much we are choosing to value the company at for the purposes of making the equity investment. And for a traditional equity investment where it's like Y dollars for X percent of the company, you have to, in order to calculate X percent, it's, how much of the total value of the company is Y, and that's the percent they just bought, to oversimplify things, right? And then there are other vehicles for future equity, like a safe. And a safe is saying, well, at a future liquidity, or sorry, at a future transaction, we are going to convert this into equity at a predetermined cap on the valuation. So, like if you say it's like a $5 million, cap on the valuation, and it's a $500,000 investment, that's obviously 10% of the company. But the reason that's a cap is because you could, for that next like round where that would convert, not ask for 5, ask for 10, and then suddenly that investor who invested 500 is only getting 5% instead of 10%. And so we put that cap on there to ensure that they don't get less than that set equity percentage for their investment. But it works the other way too. So if you set a $5 million valuation cap and you only raise, 1 million, then suddenly they get 50% of your company at that point. So there's some strategy and math that goes into how you calculate this shit. But anyway, so that's the valuation side, and then the ask itself is how much you're asking for from investors, which is that 250 versus 3 to 5 versus 10 million. The last thing that I wasn't super clear on, and I don't know if you have any further context here, Cameron, but was on they said they recently signed an NDA with UPS and biofuels, and I'm not like, an NDA is a non-disclosure agreement as I know it, and so like that's choosing to exchange information and then agreeing to not disclose said information to outside parties. And I'm not sure if this was supposed to be an LOI or a pilot or something else. Otherwise, I'm not sure what it means in this context. I'm not sure if you have other context.
I don't have any more context. I think it's more, I think, potentially trying to signal that they're in conversation with a larger corporation, which, like, I think it's interesting, but I don't know what you're, outside of you just signing legal documents to have a conversation. And that actually could be good and it could be really bad in the sense of, like, now you can't go do certain things because you have signed this particular document. And so if you're counting this as what we'd say is like traction, I think it's a big leap for us to see this as a traction to prove the fundraising raise. And that's kind of, I think, in our head, just for your education, is like the way we see this question is you have this ask to raise X, Y, and Z, and you're kind of navigating it. And then the point of evidence you're speaking to is a NDA, so a non-disclosure agreement, which doesn't necessarily validate any forward movement in terms of like actual real traction. It's just having a conversation. So not discrediting like you've done work to get in front of these potential customers or suppliers or whatever their relationship is. And I think that's the context that's missing. And like, what does that mean to actually proving your startup?
Yeah, couldn't agree more. But let's maybe spend the time talking about the ask question here. So to go back to that, so it's deep tech, it's hardware. They said we think $250,000 of an ask is more than enough to get us started. Some of my team thinks 3 to 5 million. My contract manufacturer suggests 10 million. So let's maybe dive into this question a little bit, because I think this one's actually super interesting. There's a couple different ways to kind of tackle this question, and absent a lot of like details and special circumstances and everything, we can only kind of speak in generalities. One of the generalities that I just first want to start with is bigger is not necessarily better. Smaller is not necessarily better, although I think on average smaller tends to be better. But if you can get to the next major milestone with 250, then raising 10 million I actually think is a problem, because that's going to lead us to making much broader claims for much more progress with much bigger bets and risk than it warrants. And so it doesn't decrease our chance of failure to get 10 million. It increases our chance of failure and makes it a bigger failure. Whereas if we take a much more, scrappy approach and find a more near-term milestone that we can prove with a smaller bet, then that tends to right-size all of it. Now, all things being equal, that wouldn't be true, because you could take 10 million and then make a 250K bet. But the problem is that people who invest on a $10 million round are looking for a different outcome than somebody who is investing on a 250K round. And so that's why you get that disconnect, is because the 10 million people are going to expect a big play and a big move that you aren't ready for. And the 250K people are expecting a smaller move that you are more ready for. Again, assuming that that was actually your current stage. So bigger is not necessarily better. It can also lead to a lot of consequences downstream, where you end up losing a lot more of your company to further dilution when you raise funds in the future. Because you end up having a round that's on less favorable terms the second time, because you had some setbacks, in that first one. And you can only get bigger unless you have a down round, which is really bad. So if you raise 10 million, then your next round is going to have to be even bigger. So I just want to say bigger is not better. I don't want to like filibuster and do this the whole time. So I don't know if Cameron, if there's a way you want to come in, and I certainly have more that I can say.
No, I don't have anything major to add outside of just through in the chat the article that the pivot that we dropped related to raising big to avoid raising again, and that's often kind of part of the reason people want to, is they're like, oh, if I just raise for this period of time, we're good to rock and roll, and so that can be challenging both from like what's the path for your investors to get their money back, and then it's likely going to take you a long time to raise a large round of capital without the evidence to warrant that capital currently. So based on the education that I have from your question in the submission form, right, to raise a $10 million is pretty far away from my perspective, right? Whereas like if you right size it for, hey, we're trying to prove out this key milestone, this is what that use of funds would ultimately look like. And so when I think about any particular ask, is like we think about what is the next major milestone that you're trying to get to, and a milestone really looks at like what is the next major proof point related to your startup that the next round of an investor is going to need to see, and then what activity do you need to do in order to get to that proof point and milestone, and then how much funding do you need to actually get there, and how are you using the funds, and that's kind of how I would think of the math equation. And you don't necessarily want to raise more than that, because then that changes what the milestone you'd be going for is. And the further out you get in terms of like how you're going to use those funds, the more assumptions we're stacking on what that risk actually looks like that you're proving out. So those would be my only additions, but definitely check out that article. It's a great, quick deep dive into kind of why not to raise so big.
And so setting that kind of big general thing aside, and I throw up on the screen while you're chatting that Alex claimed the question in the chat. So now we can refer to Alex by name, but otherwise we respect anonymity until anonymity is breached. So Alex, like the way to think about, another way to think about round size that's not like don't do this, but like maybe go ahead and do this, is that the way that a lot of founders tend to think about the raise size, like, is how much money do we need to keep moving, and it becomes like a budget. And so then we go to investors and ask for a budget. And that's kind of like that's a weird way to think about it, because they're not giving you a budget. They're actually making a bet on getting to a particular point. And so that's what we're actually saying. We're saying, give us X number of dollars so that we can get to Y milestone, because Y milestone means, whatever down the stream. So that's what we're actually trying to do. And so if we reframe it that way, then it becomes like, what are we trying to go? And like, what is that going to get us? And like, are we trying to get to like our first major revenue generating partnership? Are we trying to get to a set of unpaid pilots, or a set of paid pilots? Are we trying to get to market? Are we trying to get to a certain sales threshold? Like, where are we trying to get? And then we work backward from that milestone, right, to say, here's all the activities that we need to do that. And those activities multiplied by unit time, like how long it's going to take us to get there, that's our burn, that's our runway, that's our ask, right? And so that's how we get to, again, papering over all the rough edges, that's how you actually get to that number. And so then the question becomes like, it's not just generically, do we raise 250, 3 to 5 versus 10? And by the way, this is normal for all founders to get really dramatically different perspectives, even from different investors, on how much they should raise. So just know that like this like confusion is super normal. And then what are you doing there, Cameron?
I have an itchy ear, so sorry.
We just like
was it making noise for you?
We were getting a record scratch.
Little turntable action.
I should have like and said something else, again, but um, so anyway, so then like so that confusion and that like disagreement is fairly normal. But so then the question to ask yourself is like, what is the next milestone? Is that the right milestone? And how much cash we need to get there? And then, as we were saying before, probably don't raise more than that. I mean, a little bit more because like buffer, but don't like raise a dramatically different amount because it's actually going to be problematic. That's all we can kind of say on that, I think, without more detail, which you're free to put in the chat, and we'll come back to it. And then I noticed, Alex, you also dropped into the chat that your NDA was indicating interest. I know Cameron already asked you for more details in the chat, but throw more details down that because we'd love to come back to that if we can. So drop that in there and we will come back to that. But I'm saying we're going to come back to it because there's a 1 minute delay. So by the time you hear this, feel free to drop it in and we might come back to it fast. But there's a 1 minute delay on the LinkedIn side, not on the YouTube side, but on the LinkedIn side. Okay, cool. Next question. You ready for this, Cameron?
Let's do it.
All right. So this B2B SaaS, small batch perfume makers. Okay, cool. I've noticed like an increase in like beauty related products in the Sacramento area. It's kind of cool. All right. Have about 60 users.
Are you in the market for them?
I mean, not for the perfume, but I buy beauty products. Sure. Yeah, absolutely. I'll own that. I just like you bought a new moisturizer for my face like a week and a half, 2 weeks ago or something like that. And it's got a like dramatically different texture than I'm used to. It's like gelatinous, like it's like Jello. Super. So like if you stick your finger like to try to like scoop some out of the little container or something like that, it actually just depresses first. And so you got to like curl to get under to get it out. It's like a super weird.
Is it beef tallow?
No, it's vegan. So I don't think so.
It's the opposite.
It's probably not a seed oil though either. It's like a Japanese thing from a brand my wife really likes. But all right. But anyway, all right. So we have about 60 users who track their formulas with us. I'm assuming this is perfume formulas. They use it, but when I bring up pricing, they kind of shut down, getting the vibe that it's a lot of them don't really see this as a business, more like a creative thing. Not sure how to position paying for software when they're not focused on revenue.
Sorry, I got a little lost in the chats because I was reading what Alex said. So if you are willing to go first since you read it, and I'll
sure.
reread it.
I just wanted to give a space because I'd read it out loud. Okay. Yeah. So a couple things like you're targeting these small batch perfume makers who don't see this as a business, they see it as a hobby, and they don't want to pay money to support their hobby. So there's two things that I actually think are important threads to pull on, and they're both pointing in the same direction, unfortunately. So one is like you're targeting people who don't really see this in the same way. And so like the value proposition that you're delivering to them doesn't really resonate because they're doing this for a different reason. They're not doing this in order to make money and for to be more efficient. They're doing this because they like tinkering in their perfume meth lab in their basements to create these different formulations. That's how I'm picturing it. That's how I'm picturing the small batch ones. All different kinds of equipment. They've got like, little Bunsen burners and they're dropping chemicals in with pipettes. That's what I'm picturing. And don't disabuse me of this, people in the chat. This is what I'm going with. So those people just fundamentally might not be your customer then, and because they just don't see it that way. And so is there a small batch perfume maker who does see this as more of a business? They're selling at a farmer's market or something like that, or maybe they're trying to break out of that small batch market and into a larger market. They're trying to get distribution through a store or something like that. The other thread to pull on here is that I want to challenge the premise a little bit. And that, or maybe a lot of it. When we talk about pricing, they shut down. You're getting the vibe that they don't see this as a business, but more of a creative thing. And how do we position paying for software when they're not really focused on revenue? I actually want to challenge that premise. I actually think what they're telling you is that it's not worth the money. And like, there's two ways to look at that. The less common way is that your pricing is wrong. The more common way, far more common, is it's just not that important to them. And so like they'll tinker with it for free, they'll sign up for a free trial, they'll do a, you know, a little free test like you've given them here, but it was never high enough on their priority list for them to fork over any money for. And so you're solving a real problem, but that problem lacks sufficient severity and urgency to motivate the kind of decision that money backs up. And that's much more common, in which case that could be, again, you're targeting the wrong customer, and that could be the reason why. It could also be it's just not an important enough problem for your customers. And whoopsie doodle. You ready to chime in, Cameron?
Yeah, the thing I would add is we're kind of playing the blame game on the customer, right? It's like, oh, well, it's just a hobby thing for them, even though, you know, many people put a lot of resources into their hobbies in the process, right? And so I think it's really about connecting what you're offering to the like outcome that it's creating versus it just being we have this, you know, technology that does something for you, and maybe your value proposition to them is to make more money when they want to be able to just that maybe they're not really interested in making more money. They just want to be able to produce more for their friends and family, and that's what their core outcome is they can do more at scale or something of that sort, right? And so it's right sizing what pain point we're solving for, both from an urgency and severity, and then like how does our product lead to this outcome that they want, and we're speaking the language that they ultimately aim to. And so we can't just push it off on them that they're just a hobbyist in the space, because many people spend a lot of money on their hobbies.
Cool. All right, let's return back. Alex did provide more detail in the chat, though. First, he provides a thank you. So you are most welcome. Thanks for asking a question. We really love when you guys chime in and ask questions, especially when you then join live and we can have a little back and forth. That's awesome. You rock, Alex. All right, and then the detail on the NDA, and I'll let you take this one first, Cameron, since it was originally your question.
So just reading the question out loud here, or the additional context. So FedEx and UPS are interested, but UPS was amazed by our SAF presentation. We are going after an LOI contract on SAF and selling a SAF bio box. So I'm guessing that's kind of your offering. And first off, congratulations on making it to the finals for the Western Placer Waste Management Circular Economy Innovation Competition.
Even more detail.
Even more detail that I'll read out here. So the discussion with UPS was, how can we help you hit all your global aviation fuel and biodiesel truck flat needs? Globally, in 1 year, UPS consumes 1 billion gallons of aviation fuel. If we convert all the petroleum aviation fuel to sustainable aviation fuel, could be just 5 billion in revenue with just UPS. We also have other big target customers like Delta, and had serious discussion with Delta too, but UPS seems most excited of the potential clients. And so I think awesome, work in getting in front of these customers and starting to have discussions with them. And where we will likely be pushing you is, how do you move this from interest to intent? And you have some artifacts that you're aiming to dive into around like building getting a letter of intent, or some sort of paid contract or a paid pilot of sorts. And so the more you can move into what we'd say is like stronger evidence, related to them, just instead of them saying, hey, we're having a conversation with you, like they might be just interested in learning more, but that doesn't signal necessarily intent to have you as a paying customer, and what the like mechanisms for that purchase are. And so I see if based on your monetization strategy, that could be a $5 billion opportunity with one customer, but are they going to just dramatically change all of their fleets to biodiesel, and does that actually work for them feasibly? And then like what are some of the like larger switching costs to that, because they have infrastructure set up to deliver fuel in the current system that they're engaging in. And so I think understanding a little bit more in that nuance, and then who is actually the economic buyer of it. Are you talking to the person who actually has budget authority to make that decision, or is there a long process to get in front of the person to ultimately do that? And then, like, what is the size bet that they're willing to take in terms of bringing you on as a customer? So those would be things that I would be thinking through. But the big one is like, I think you're right in saying indicating interest, but we say then how do you turn that interest into intent? And you have to have some sort of ask, and we have what we call the team ask. It's the four asks, which is ask for time. So is there some level of like significant commitment that they can make in terms of time, where they set up a 2-hour meeting with you to run through logistics, and so it's not just a 15-minute conversation but something more robust. Then there's effort. And so we're asking them to maybe pull a bunch of data related to their fuel needs and all of these things that aren't necessarily easily for you to get your hands on outside of it. And so they're actually spending some effort to demonstrate the problem and the urgency and severity related to it. Access. So if this person that you're talking to isn't the economic buyer, are they actually willing to make that introduction to the person that is, and give you that access to actually having that conversation with who the decision maker might be? And then the highest form would be, money. Is there an actual exchange of, financial capital for your offering? And so that could be, earlier stages, the letter of intent, and then obviously having a signed contract for the solution overall. So that's all I got there. I'll pass it to you, Jay Doom, for anything else.
Super well done. That was pretty comprehensive. So I actually only will add, I think, one thing, which is a little tick variation on the idea of intent. So we're talking about like how do we go from interest to intent, which is totally valuable. The other end of that spectrum is that there was intent at the outset. And like, what is their intent for engaging in these conversations? And the more that we're able to surface what their original intent was, the more that we're able to understand the context of those conversations and how valuable they might be to us. So I'll give two completely different sort of polar opposite examples. So one is their intent is to find additional sources of biofuel. They're like, they're the ones who are responsible for purchasing that. And so, hey, yeah, we're gonna be talking to some people. We're gonna try to get this shit dead. And so then they engage in those conversations with people like you because that's what they're trying to do. And so then this is a very early form of a sales conversation because that was their intent coming in. All the way at the other end of the spectrum might be that their intent was to help you out. Answer some questions, give you a little perspective on this. We'd love to see more companies like this out there. So let me lift these guys up a little bit and talk about this stuff. And or I just love talking about biofuels, and like let's talk with some guys who know what they're talking about. Like there's a number of those reasons that where their intent is either to help or to be entertained, or like there's a number of those things, and very often those conversations fall into that category. And when they do, like we are thinking that this is really awesome, and we're chasing UPS. And it's like this big logo. It would be awesome. When really we're actually not chasing UPS at all. We are just being unintentionally strung along by somebody or a small group of people who are just curious about this space or otherwise interested, but have no subsequent intent. So the more that we can like look at what was our ask to get them in the room in the first place, and how did that conversation start, the more that we can see like from their shoes, what do we think their intent was in taking the conversation. And the more that they think it was a sales conversation, the better, that signal of intent is. So I just wanted to add in that other side of the equation too. Doesn't take away, Cameron, from anything you said, because I think it's 100% right. Cool.
Cool beans.
All right. Well, we got more questions, y'all. And then Alex, definitely feel free to add more context if you're still here and didn't run away. But since we have a minute delay, we'll take a question while we're waiting. So this is a question that was submitted in advance. You guys can always submit a question in advance. JDM at about hit the calendar link to the form that you do there. If you're listening to this on the podcast feed, or if you're watching the replay, you'll find the link down below. But a little more breathing room in the form. Here we go. So this is B2B SaaS for parking lot striping contractors. I read that as stripping contractors, and I thought that this was a very different question. Parking lot striping contractors. Is this the people who paint the line on the parking lot? Is that like literally what we're talking about here? I think it might be.
I think so.
Apologies for my ignorance on the subject. Okay, so they're about 79,000 in ARR. Well done. 102 customers. Product works fine. People pay. Churn is whatever. I already have a follow-up question, by the way. Honestly, just feeling really unmotivated about parking lots. Is it dumb to pivot away from something that's working just because it's boring? Co-founder feels the same way, but we're worried we're being irrational. Can I tell a little story?
Sure.
So I had a startup. What was this? Maybe close to 10 years ago now. And our this keep in mind this was 10 years ago, right? So put it in the context of like 2016, 2017. And the whole point of this startup was it was an app that you could use to that all of your friends could be on, that whenever you wanted to like go someplace for food or drink with friends, you would say who was going and it would recommend the one right place for all your friends to go to. Like, here's the place that everybody will be most excited about. And so we, in order to make that work, that was our eventual vision. And like our MVP for this was a single algorithm that just looked at where you wanted to eat, right? Because we wanted to test like this algorithm. And so we actually had this like this graph density algorithm. We can nerd out about that sometime if you want to, but like we had this like graph density algorithm that actually looked at all the things that you said you like, and then looked at the not only the underlying ingredients in the things that you like, but the flavor compounds within those ingredients. And so it literally looked at the underlying compounds that were in Mexican food. And we find like a significant overlap between some of those underlying flavor compounds, for example, in Thai food. And so it can then make very interesting recommendations for restaurants that you might not otherwise go to. That's a little bit more robust than just saying like, you said you like Thai food, here's a great Thai restaurant. And then you could, of course, feed the algorithm back and do the whole thing. There was no AI in this. This was 10 years ago. So that was what we did, and we had a prototype working of the algorithm and all that stuff. And if you're wondering how the hell this is connecting to this, here's what happened. So what happened was that what we ended up on this the UX of it would give you a percent out of 100. What percent likely are you to like this restaurant, this recommendation? This like an X% match for you is how we framed it, and that was based on this underlying algorithm. Okay, what we discovered though was that there is a narrow range of this match that had any relevance whatsoever. So I don't remember the details off the top of my head because it was close to 10 years ago. But if you were below something like 80% or maybe 75%, if you were below this threshold, people were like, that's not a big enough match. I don't want to go there. On the other hand, if you gave a really high percent match, like 98% match or 100% match for you, people would go to the restaurant and they'd be far more critical and they'd be disappointed because they were expecting something higher. And so there was this narrow band of recommendations where if we gave you and said this was an 84% match, and we have even casual reason to believe that you would like the food, like you just like Mexican, and we told you the number was like an 82% match, and you go there and you have a reasonable experience there, you are going to think that the algorithm did well in its recommendation. So what did that translate to? It meant all this cool shit about this algorithm and the underlying flavor compounds did not matter at all. Because all we could do is just say, you like Mexican food, look at the reviews for a restaurant, chuck one in front of you, make up a number, and you will get all of the same value you would have gotten out of the tool as if we had this sophisticated algorithm behind the scenes. And so at that point, when we learned that, my co-founders and I immediately lost interest in this. And we were like, well, this, like, what do we do? Like, we aren't in this to literally lie to somebody about a percentage to solve the problem, even though it does solve the problem that they're asking. So for us, that was a big reason to kind of start pushing us out of it, just because we literally lost interest. And when you're working on a startup, you're doing something that is so time intensive for a long period of time. This is going to be your life for 7 to 15 years. This is a long-term thing. This is not something I'm going to do for 18 months and then get a big payout. 7 to 15 years. Like, we're going to be spending a long time on this, and it's going to be harder than you've ever worked before. You're going to be eating like the whatever the metaphorical equivalent of ramen noodles in your class of living right now is for a long period of time in order to hopefully get that big payoff that's super unlikely anyway. Like, that's the reality of this. And so if you're not in it, you don't want it, it's going to show up in your work, and it's going to make you less likely to succeed. It's going to show up in your pitch, and we're all going to see it. And it's you're just going to be miserable anyway, and it's a terrible idea. Now, if you can get excited about still solving the problem and still being like, we're doing something, if we can be excited about the process and excited about entrepreneurship and excited about the mechanics of this and doing this thing, then I think that that's great. Because it's like, and I'm going to use a metaphor that I feel self-conscious using in front of you, Cameron, which is like a marathon runner. So I'm the guy of the two of us who does not run the marathon. But like, if your whole goal in running a marathon is to win, and that's why you do it, that's a terrible reason to run a marathon. Like, if you don't like the process of running a marathon, it's awful. Like, it's a terrible thing to do. You have to get some satisfaction out of the process itself. And it's the same thing with entrepreneurship. If your goal is to get rich, startups are the worst way to do it. Don't do that. Go into high finance. Way easier to make a good living off of that and get your millions of dollars than it is. You have to like the process. So if you fall in love with the process, that's great. And so in our case, that zapped our confidence. And then the second thing we had is we had a business model problem that I won't go into because it doesn't matter here, but like, we had a business model problem that was kind of intersecting chronologically at the same point. And it was kind of a gnarly problem. We tried a few things and they weren't working. And so we had some hypotheses, but we were just at this point in this groan zone where it's like, we're now less excited about this. Our conviction is a little lower and our ability to make money doing it because of some of the business model challenges. And so it's like, do we want to keep, trudging down this path? And we decided no. So I give you license to decide no in this situation. But if your whole point is to be like crazy excited about the actual solution itself, then I think that maybe this kind of like scalable, like, venture scalable entrepreneurship just might not be right for you. That having been said, if it's just like something that is just not interesting for you to take further, then I would probably do some introspection about what would be, and then see like, what is the true distinction between those two things. But that was a really long answer for that. Thank you for indulging me on the story to get there.
Awesome. No, it was a great story, and I think perfectly dials in an answer to it. And that lived experience is super key. So I don't have anything to add.
All right. Awesome. Well, if Alex did throw a little reply here, gave me a great idea for follow-up. Thanks. Our warm intro is from the head of UPS Pilots Union. We will follow up and ask him for a more informal meeting, just a time ask. Okay. Awesome. Let us know how it goes.
Cool.
Looking forward to hearing.
Yeah. Come back when you get the ask out there and see how that lands. We look forward to hearing more.
Cool. All right. Well, we have one final question, and so should we make it like a lightning round?
Yeah, let's make it fast.
All right. I'm going to tee it up, and you're gonna go first. All right. Here we go. SaaS for professional genealogists. Okay. They're at the unpaid stage with 9 genealogists testing it. They love it, super engaged. Problem is there's like 2,000 professional genealogists total in the US. Did the math, and even if we killed it, that's maybe 240K ARR ceiling. My co-founder wants to go after hobbyists or expand to historians, but I think we should stay focused, stuck on whether small, passionate market beats bigger, indifferent one. These customers send thank you emails, which never happens. That's cool, at least. It is cool. Take it away, Cameron.
Yeah, so a couple things that stand out. One is just always going to point out the unpaid pilots. So they're loving the free product that you're giving them. So, but we don't know if there's actually willingness to pay. And then I think the larger thing is, I guess there's questions you're having about the scalability of this opportunity, particularly from market size. If you highlighted, if you're able to capture the full market, it's less than $1 million or less than even $500,000 in annual recurring revenue. And so a very small market size. And that doesn't mean don't go after it, because there might be applicable markets out there. But I guess the question I'm thinking through is like, is this your like beachhead market that you grow into a larger offering? But it still goes back to like, why are we we're calculating the market size on their potential willingness to pay when we've never asked them to pay. And so we don't really actually know if there's even a need for the genealogist overall. We've kind of like said, okay, that's said and done. Like, is there another market opportunity? And I think you do want to be looking, if you want to build a highly scalable venture backable company, you need to find a bigger market because you're never going to raise capital on that. But if it's something that you want a lifestyle business, again, probably still leaves a little bit to be desired from an overall like actual salary lens, but overall could be more interesting from that lens. But I think the two major things I want to point out: the unpaid pilot, and then if we're thinking about going in these other markets, there should be a theory of how we go from genealogists to the larger market. And I wouldn't necessarily just pivot at this time because we haven't even figured out if genealogists are willing to pay. Before you make that decision, why not just ask them to pay and see if there's willingness to pay? And additionally, is like, what is the size of the problem? And we might just be, under pricing what that return on investment is. Because if again, I don't really know exactly what the pricing mechanism would be. I guess if there's 2,000, we're putting it at what, 12,000 a year. Does that math work per genealogist? So it's like, what's their return on investment? So that's my medium lightning.
I mean, you pretty much covered everything. I don't really think I have anything to add. So we could go into like, market opportunity analysis and like, how do you identify, growth markets or pivot markets and all that stuff. But I think I agree with you, Cameron. It's too premature. We don't even know if we have one market yet. So let's not talk about others yet.
Cool.
So we're gonna take our license as the only people at the microphone right now to say, we're not gonna answer your question. You don't deserve an answer to your question. You got work to do first. Go prove that the genealogist is a market or not in the first place, and then come back and report on that. And then we will happily dive into the next step. And good luck getting customers to pay. Cool.
Well,
all right. Last thing.
Yeah,
Go
last
ahead.
thing. Go ahead. Well, I was gonna maybe you can talk about the investment readiness, and I'll talk about the venture school. But just want to say thanks everyone for hopping into our weekly startup reality check and AMA with JDM and myself. And if you're listening on the podcast, thanks for tuning in. A couple asks here from us is, one, if you're looking to, start to build the early stages of your engine for growth, and so you want to learn how to systematically acquire customers, be sure to hop into checking out the Traction Lab Venture School. We have our second cohort starting to fill out. We are ending our framework sessions with our first cohort, and then we'll be diving into that robust support over a year-long engagement. And so be sure to hop into the venture school, and that's tlvs.link, or as Josh will say, up in the QR code. So feel free to scan that, and then I'll pass it to you for the investment readiness engine.
Well, awesome sauce. Thank you so much. I'm going to leave that QR code just for a second so people can scan it while I start teeing up our investment readiness engine. So we're super happy, actually really thrilled. We just announced this morning a new program from the Traction Lab called our Investment Readiness Engine. And what we are doing with this, with some generous funding from the City of Sacramento's Innovation Grant, is we are going to take 15 companies over 9 months through a process of systematically doing two things. So one is capital readiness. So we're gonna dive deep on financial modeling, investor metrics, data room prep, evidence-based narratives for actually closing some of those deals, all of that stuff. And then secondly, we're going to work on customer acquisition and go-to-market, sales process design, like pilot development, revenue acceleration, all of that really cool stuff. So we have that dual engine approach for the investment readiness engine. That is the QR code for that. And basically what we're looking for is 15 companies to work with that are looking to fundraise. And we are going to start with 15. We'll end up with four to six who are competing for probably about $100,000 equity investment into that company. So super excited to be putting that special purpose vehicle together for that investment. And we'll also have some non-dilutive experiment capital and so forth. If you want to apply hit that link, fill out the little form. It doesn't take very long. And then, regardless of whether you're selected or not, we will, within a couple of weeks, provide, just for filling out the application and taking the time to do that, we will be providing a little investment readiness, a little assessment that'll at least give you some value for spending that time filling that out. And then we will, have some conversations and select some companies to work with, and super excited about. So special thanks to the city. Looking forward to working with those companies. By the way, this doesn't cost anything to founders, and we don't take equity in the companies. So yeah, aside from the SPV, which is that's different, but not to participate in the program. Cool.
Sweet deal. Awesome.
Sweet
Well,
deal.
I think with that, thanks everyone for tuning in. And JDM, thanks for fun as always. Always enjoy plugging in and supporting founders as we do. And hope you all have a great weekend. And with that, we'll exit as always with a good bye.
Bye.